FOMC day, March the 16th. And again, an exciting green day to start the day out. But I'm just going to say it. You really have to be careful. And we've talked about this, that Wednesday was going to be kind of this day, and everything that happened between now and Wednesday, we kind of had to just take a half a beat, if you will. Whoops, wrong one. Let me stop that share and share the different screen. Okay. And okay, so the FOMC comes out at 2, the notes, and then we'll start to see some activity. And then as it processes through, we will get a sense for whether this rally is real or false. And even then, because we've got 2 more days and we have all of this indecision that's happening, I really want you guys to be very careful about being too aggressive when you're going into different stocks. Like, there are definitely prices that things are coming up for sale on, and there's no need to be aggressive in your position sizing or too fast. For example, today I have actually sold some things that I was long, and started reapplying shorts carefully, very carefully, and in small size at different spots, because it's very hard to know how much this correction will be. Now, as you know, yesterday, I feel like I'm going to take a victory lap on it, but honestly, I feel like I'm just lucky. And that was on BABA, where I told you guys to lighten that all the way up, but still be very cautious in this marketplace. And also PayPal, which has rallied aggressively, because it's really interesting, because I literally this morning saw CNBC start to talk about all the things we've been talking about for the last few months on why we're short PayPal. And then the minute I'm like, I'm going to lighten up my short, they're talking about whether or not it's still a short at these prices. Again, I think that he still has a lot to prove, but the reason I lightened up on the shorts really has to do with the fact that my biggest concern is they end up with transaction fees that the analysts in their estimates that they put in the various databases did not incorporate foreign transaction fees coming from 2 million Ukrainians leaving the Ukraine, and a banking system, which I have very gently and softly said may not be sufficient for that type of outflow. I'm just going to say it that way because I'm not trying to get my videos taken down off of anything. So that being the case, if one is trying to get money to that region, any international cross-border transaction fintech or company should in theory benefit in a way that may not be accounted for in numbers. That's why I'm bullish, and not bullish is really the wrong word. Cautiously optimistic that the quarters might look a little better for a few companies. That's probably the right word. And that's true of both Western Union and PayPal, because remember, 2 million Ukrainians in a global environment like this, where you're not going to be traveling to the Ukraine necessarily on the immediate, that does result in a certain sort of activity in the financial banking system. And it happens to be some of the most highly feed activity, period. You know, when you try to get money overseas on the quick, you know, there's set fees for it, but it's not, you know, you're going to lose a fraction of what you sent over. So just realize that that is my call. It is not that I think that PayPal is this amazing company. I was totally wrong or anything like that, and that they've totally going to fix it in this next quarter. It's simply that I suspect that the analysts may not have already incorporated in those foreign transaction fees that will necessarily be happening with 2 million fleeing Ukrainians. Okay. Now, I do also want to mention a couple of things as we go into FOMC and beyond. And that is, I spoke about this very briefly, and I realized that this is probably very confusing for folks why I spoke about it and what I'm speaking about. This is instruments of national power. And usually I am not a global macro specialist in any way, shape, or form. I've certainly worked with a lot of global macro people and been responsible for appreciating why their positions are the way they are. But this is not my main cup of tea, if you will. But nonetheless, this should be fairly knowledge, you know, in the global macro community, they would know this. And that is this dime model. Now, there are more extensive models, okay? For those that wish to call me out, but this is a basic framework that people look at. And for America, largely speaking, we have used M for our foreign policy. We are thought to be very poor at D globally. And then I and E is done in a way that's so subtle no one talks about it. Traditionally, E is always thought of as economic sanctions, fiscal monetary policy, embargoes, tariffs. But one of the things in E that everybody in the marketplace probably knows, and certainly China and the US government know, is the financial markets themselves. And I've mentioned this, but I'm going to try to be more direct this time, and definitely ask me questions, put them in the Discord, my subscribers. If you're not a subscriber, consider it. We'd love to have you. You'll get the videos a lot faster. And also, you can comment in the YouTube videos. We always love comments there. But financial market mechanics is a real thing. And this, in the last 2 years, I've seen more financial mechanistic tests of our financial markets than I've ever seen before. AMC and the volatility that ensued with the meme stocks has absolutely tested the options market in ways that are beyond what we're going to talk about today. The market volatility in general, the transition to retail, and a number of different things that are very unique to the last 2 years in the financial markets has tested financial market stability, capability, and the actual mechanisms themselves, independent of any fundamental work, and actually in many ways independent of technical work. Technical work might follow subsequent, but it wouldn't be the leading driver of this. This is pure mechanics 101. But Mechanics 101 is not a common area of expertise for folks. It would be something that the macro people would investigate and try to understand. And then individual players within their markets might know it just from being gray-haired in the marketplace. But we are experiencing a number of financial market mechanistic tests that are happening. And that's what I just want to kind of go through a little bit today as you're trying to understand how to put your positions on and understand whether or not you want to be shorter term in the options market, maybe you want to be closer to the front, or maybe you want to position a certain way. But anyone that's not considering this or really understanding this is probably at a bit of a disadvantage. Now, I just remembered, I forgot to say, which I'm supposed to say at the beginning of the show, past performance is not indicative of future returns. And, that is something that we live by here. But one of the mechanical faults today that's making the headlines is this. It's the Russian default of debt. There are actually probably no less than 3 that are happening very actively in the marketplace, but I'm going to talk about 2 of them, I believe, today. 3, well, there's 3 that are very big. Anyway, whatever, we'll talk about it in a second here. The mechanical issues with the Russian default is that these contracts, because of the nature of how they're struck, require delivery of US dollar assets. Now, because of it is unprecedented for sanctions, given the size of the debt, and the size of the debt is not something so substantive that you couldn't use the credit default swaps market to try to hedge it out or attempt to hedge it out in some other way. And this is something that is a little bit advanced for this particular set of videos right this minute. It's more of something that I might do in the tutorials, but you could absolutely hedge out your Russian bond risk. But what becomes really complicated is assessing what is the nature of that risk. Now, this is going to be regulated under ISDA. It's a little bit of a different animal. So Russia's happy to pay it. They actually have the capital for it, but they're not actually allowed to access it because of the nature of how we've done the global sanctions on Russian banking and Russian money, et cetera, et cetera, et cetera. Technically and absolutely, by definition of the terms of the agreement, they are in default. Now, if you are a debt holder, this isn't fantastic for you. But it also is a little bit annoying on how you want to resolve it, because at the end of the day, the debt holder, not the debtee, but the debtor, the debtee, not the debtor, sorry, one way or the other, whoever is owed the money, just like if you owed your landlord money, they get to set and adjust the terms according to whatever they feel like. And so there is a way for this to be worked out, so to speak. How it will be worked out, what the timing of that workout is, and what will happen has a really unique quality to it. And it's why we keep coming back to this whole slide over and over and over again, which is, what do you do if you're a country watching this, right? Okay, so I want to just keep that in the back of your head, because this is a gigantic unknown that will weigh on this marketplace for multiple years. I'm not stoked that as an American, I'm not stoked that we've strategically played it out this way. I'll just be honest about it, because I think that there could have been other ways that would cause less instability all around and maybe allow there some time for people to figure this out. Instead, I'm a little bit concerned that what we've really done is put our place as a reserve currency a little tiny bit at risk. And realize that at one point, just after World War II, most of the world's reserve currency was US dollars, like 80%. So coming even down to 60% and having it stabilize over the last 10 years has been nice, and is still a huge, wonderful thing that we enjoy. But these whole recent market mechanistic concepts that are really based on this reserve currency issue are going to continue even after this little period that we're in right now. And so to the extent that one is still learning about this, I want you to continue to learn about it for sure, because it's not going away. The book, a review that I did and that I will try to highlight a little bit more on a different day, is Ray Dalio's book, Perspectives on Changing World Order, and it's in the Discord. I'll place it in the Discord so you guys can start to get smart on it. I don't totally agree with what he's saying on the debt side, but I don't disagree with him so much as just have a difference of opinion. But the book is brilliant. It really talks about this. So this is one of many mechanistic things that continue to come up and crop up day after day, and it's not great. Okay. The second mechanistic thing that I really want to reference is this nickel market. This is the nickel. Some of the metals are traded here in the United States on the CME via Globex, and they have a particular set of rules and regs. Then the London Market Exchange, the LME, trades a bunch of the smaller metals that I really only know in the periphery, because the companies that I cover do in fact have exposure to the entirety of metals and mining. So I just kind of have to know a little bit. But I also know enough that the rules of that exchange differ distinctly from the CME to try to tell you too much, other than the rules of cornering the market still remain. How you clear these trades out still remain. Today we learned that one mechanistic aspect of the LME is they don't have the stop limit triggers that we have in many of the financial markets here in the United States, meaning that if something trades limit up too aggressively in the United States, we'll halt that market and give it time for the market to actually attempt to clear. And the LME, they had to halt it for a week. Then they tried to program it out. It didn't work this morning, so everybody had to go back to what's called voice brokering. And David, who's always on the show and always a supporter of what we're doing here, he probably knows more about voice brokering than I could ever possibly tell you. But essentially, they're going back to pit-style investing until they can get that worked out. This is absolutely not great, because usually if you really are having supply constraints, and I know people keep trying to pretend like I might be girl by herself saying that, but when the commodities market starts to have supply constraints, you will see this happen with increasing frequency, and it's a real problem. Nickel, a lot of people are talking about the fact it's used in batteries. It is also, its primary use is actually stainless steel, by the way. It's an additive that you add, anyway, whatever, we won't go into it. But that's just something to note about the nickel market and about what we start to foresee in the future about the instability of these markets that are currently being tested due to, again, what I'm saying, the geopolitical activities that have nothing to do with markets and probably nothing to do with companies or the stability even of GDP at this point. So when I talk about risk and I keep bringing it back to this dime, that's why I keep doing it, because folks that trade in the options market, remember, we've talked about this before, yes, up and down is important, but the veracity of that volatility piece is also incredibly relevant to how we want to, which structure we want to choose, how we want to place our bet, where on the options curve, both temporally and also which strike, all that stuff really matters. But if you're messing around with this, and especially this specific piece of this, it's a little bit painful. It's a little bit painful. And I think increasingly over the next few weeks, I'll try to articulate whether it makes sense to even go into the options market or just stay in the stock market, because these swings are also creating massive buying opportunities for people to really, really get positions that they would otherwise not even have the ability to get at prices that are fantastic. Now, some of the folks out there have said that the U.S. market is still very strong. Most people are only anticipating a 25 basis point move. If we get more than that, I think that you will have a very, very awkward market behavior immediately after the Fed meeting, and then it will be quite a dance. So it would be strange if that happens. But in general, in the next during this show, in the next hour subsequent, you just kind of want to chill out a little bit, in my opinion. Now, I also want to talk about, again, the idea that China and what's going on in the rally today. And I've said this, and I realized when I was talking about ADRs, this VIE structure, sorry, I'm flashing the screen like crazy because it's trying to figure out where to even start on these topics, because they are decades of thought process in thinking about China and what you need to know in order to invest in it. And I'm trying to synthesize it down. I realized that I showed the VIE definition yesterday, and I've said it more than once, and it might have been incredibly difficult for you to then, connect the dots to what it is I meant by that. So what I've done is I've put a paper in Discord that describes, and it's actually written by a U.S. Governmental organization that describes the potential problems and potential connections and increasing connections economically between the U.S. and China. Now, it's written a little bit farther back, so it's not just talking about the problems, it's actually talking about the benefits and how we can also use diplomacy through trade, etc. But I want you to see what the structure looks like. All Chinese companies are in this structure, and it has to do with the history of how the Chinese have opened their markets, which I'll go through subsequently. But the structure is this. In the U.S. markets, we are the public shareholders, and there is a listed company that actually relates to what it is we're buying that's based in the Caymans. And that listed company has as its majority holder and the regulations associated with it some sort of translation that then goes like this over to how it would end, ultimately work out. What I realized now, I feel bad. Sorry, VIE. I'll come up with a better chart. I'm still not doing a good job with this, but what I really wanted to mention here is that the VIE structure does not give the voter the rights that it would normally have in a regular company. If the majority. The company still retains rights over and above any majority that might be created by the shareholders. So that's the first thing. The ordinaries that are on the Hong Kong exchange or in the Shanghai exchange are different. You would still have whatever rights that you would retain within the country of China. And while some people are really negative about that, I would never go that far. I actually think China's come a significant and substantial way in how they handle, any kind of issue at the company level as relates to any kind of graft or any kind of mishandling or misdoing or deception to shareholders. So I will not go as far as what some of these other channels are going. I think that's wrong to say it that way. But fair and square, the company structure of VIE protects the shareholder very little. Now, it turns out that a lot of the ADRs, all the ADRs in China are more or less structured this way. But a lot of the ADRs are 100% fungible to the ordinary, meaning if you own the ADR, you can translate it back into ordinary shares one for one. You just call your broker and you say, hey, broker, I would like the ordinary shares. And I think mechanistically what happens is if you're doing that, there's a person on the back end, this ADR arbitrage, that has to keep those two prices pari passu. And to the extent that these things do trade on the overnight, you might be able to get some of that trade off. If they're not trading on the overnight, you might have just flat out market mechanistic pressure on the stocks between the two countries as the ADR specialist is trying to do that flipping back and forth on the transaction, and also trying to keep these prices pari passu. Now, what is it that I mean by pari passu? They got to equal the same thing, and that includes the FX portion as well. So I believe what's potentially happening in this marketplace is you still have a significant amount of concern that these Chinese companies are going to be delisted, and just because of the mechanics of that, you've got some selling pressure in the U.S. that's actually forcibly relating over to the ordinary through that mechanism. And that, I can't tell you how long it will go. I can't tell you really what the dynamic of it is. It's completely unprecedented. But the idea that a Chinese company could delist or otherwise unwind a company and have limited to no impact to themselves, while the investor gets what we call hung in the marketplace, which means you get a big fat donut and they just take the money that you gave them from an investment perspective. That is 100% true. And I took some time to try to find what it was that I remembered had happened. And Yahoo at one point owned a stake in Alipay. And Jack Ma was asked to unwind it or whatever, and he did. He unwound the whole thing and pulled it back into Alibaba. This is back in, I believe, 2010. And Yahoo got hung on that. It wasn't very pleasant. But that's the story if you're trying to understand what would it look like if it happened. Do I get anything? The answer is no, and you can look at that to see what it might look like. So I do want to mention that and make sure that that's understood as to why it's very, very hard right now to really appreciate and understand what's going on here. I want to say this, it's really the structure. It's not the Chinese government. I'm not throwing shade at China or these companies. Quite frankly, they're amazing companies that grow at a very high rate of return, and they are absolutely creating value in the marketplace and deserve, to be, actively traded in the marketplace. But this structure is not the one to do it within. And as long as there's still money coming out of this structure, and this structure happened to be mechanistically attached to something else, you got to be really, really careful on your positions. Hopefully that clarifies what I was trying to say. Now, the last little thing I'm going to say on it is that a lot of times this goes misunderstood. And people will say all these things about China, whatever, and I'm just like, I don't understand. China's foray into the public, China really, let me just try again. All right. China really understands this E better than you can possibly manage, because part of the issues that happened to them from the 1800s until the beginning of the turn of this century all had to do with this E. So when China first opened up its markets, it did it very slowly, very slowly. And although this is not discussed fully in the paper that I've put on it, what I would say is there's a list of all the Chinese companies when they came public and who did the deal in that paper that is on my Discord, and you can kind of clearly see how slowly this happens. Okay, the creation of B shares tracking Chinese stocks in foreign markets, the ability to even have that happen where you could invest as a foreign investor into B shares, didn't happen until 1992. Deng Xiaoping started it back in the 80s. Okay, so it took them a good almost 20 years, something like that, because, technically 1978. Anyways, it took them a long time before they even really were okay with foreign capital coming into a public market. Private investment's a different story. That's why you'll hear me say all the time, public investment in China, you got to think of it one way, that won't necessarily affect private investment. So just be aware of that. Then you start to see ADRs even start to nibble into the U.S. markets in 1997. And then you have the market crash associated with the debt crises that were in Southeast Asia, Latin America, etc. So then you really don't get the bulk of deals happening to 99 and 2000. 99 is, of course, when the British lease on Hong Kong ended and Hong Kong goes back to China. We have what we've got going on there. But it was absolutely well known that the reason that they were so adamant and never going to let go of it or what have you was because they wanted, or that one of the strategic things that was happening was going to be the taking over of the Hang Seng market and the ability to use the Hang Seng market as a gateway of capital between the West and the East. And that took a number of years as well, because at the time you didn't have Chinese companies that were China-based only listing in Hang Seng. You had some that had some Hong Kong exposure, and therefore, so that is its own history of the markets of Asia that I'm not going to go into, but I just want you to get a sense for the timeline. China was always a little bit freaked out about foreign capital in its country. And then you don't really have ETFs launching on China until around 2010, maybe a little bit before, maybe a little bit after. And in fact, that might have been a combination of things. First of all, the ETF market has matured significantly post 2008, and the demand for ETFs continues to go like this, so it might not have been the first thing that someone wanted to do. The second thing is the sheer raw amount of companies that you could actually trade easily, because this B shares dynamic does not help you out very much, changed dramatically, and the liquidity associated changed dramatically in 2010. And you'll see that if you even go to some of the China ETFs that are commonly traded now, you won't get data before 2008. You just won't. And that's why. That's part of the reason why. Now realize that an ETF will usually give you 1 to 2 years more data than the ETF itself has actually been traded sometimes. So you really got to double check if you're trying to do more work on this. But I just want you to understand that the opening of the China market, public market to foreign capital has been slow, steady. It's had fits and starts. And this Russia situation, where the U.S. has flexed literally every possible muscle that it can to close off Russia from the rest of the world, that's why I keep saying it is a little bit scary for me as an options trader, as an equity person that needs to look at the marketplace and try to say a little something every now and then. This can't possibly be doing anything but making China very concerned about how to think about companies that are listed overseas. Now, do I think that all these companies are going to zero immediately? What have you? No, I think it will be slow and steady because China does everything slow and steady. But I would be very, very careful to the extent that you have exposure in these areas to the manner in which you have exposure. If you are still trading the ADRs, just make sure that you do use the puts market, the options market, buy puts, sell, call spreads, etc., to just try to navigate some of this crazy activity that we're going to see. And hopefully that was a little bit clearer, or at least allows you to start asking me questions as far as that goes. And the final thing I'm going to say, I also want to talk about these headlines. And I know it's really unpopular that I'm saying it, but I will say it nonetheless because this is really about markets and truth. And I'm trying to keep it only the portions of politics that affect the markets relevant to the show. But okay, so we got 2 news flow items that likely also rallied the marketplace. Zelensky not joining NATO is one, which was one of the concessions that Russia was looking for. And then this big address to Congress where he's asking for more military support. And I want you to kind of notice one of the things that's a curiosity, and I think you kind of have to watch how the market plays over the next couple days, but it is a place where I am actively kind of figuring out what kind of exposure I want. And that is here. You got aerospace and defense almost entirely in the red. And now these companies did have quarterly weakness, if you will, but they are a very obvious beneficiary to this whole situation. One of the things that we've talked about over and over again is the fact that Europe was massively underspending in their military defense budgets. And they were really taking advantage of America's, let's call it, overspend and our training of troops that we still keep, even though our troop count has drawn down extensively relative to the Cold War era. But they have really just benefited from America footing the bill for all of this. So the fact that these are all down, I can't see how you don't come out of this conflict with a bit more spending here, given the headlines and also given just what strategically makes sense in the situation. I've also said more than once that even though I think folks have this dream that the war ends and magically things go back, but there is a lot of this was not cheap for Russia to do this, and it's still the case that Russia, these are its exports. So it is absolutely all this commodity stuff that everybody needs to recover from any kind of meaningful situation, or alternatively, to store and stock in the off chance we end up with a much more aggressive global conflict, right? If the possibility of global war has increased dramatically over the last weeks, and you're looking at your grain stocks and not seeing a lot of it, then as a nation, I would hope for the sake of your people that you would consider that. This is what this is what Brazil exports. I'm looking at the wrong chart, my bad. Apologies. This is what Russia exports, and Belarus, let's see where we go here. This is what Russia exports, and I gotta think that, since he's got it and he's a huge percentage of it, and the way that the commodity market prices are set globally, there's more than one way to make Europe pay for the war that he just waged. So as we've mentioned before, if you're going to put on your option strategy, consider using calendar spreads. We did them definitely, and they have helped protect the volatility that we're seeing in this marketplace, excuse me, the volatility that we're seeing in the marketplace, um, because the vol in the front is still very strong, the vol in the back and the options that you might own farther back is still allowing you, some sort of diagonal spreads. So you can do diagonal spreads by selling calls closer and then just continuously rolling them as they play out to different strikes. If that's something you're interested in, we probably have to look at it individual stock by individual stock, but it is something to consider in how this plays out over the coming weeks. Let's see if there's any final things I wanted to mention. I think, yeah. Oh, Brazil. Sorry, I wanted to just mention again, Brazil, given what Brazil exports, is poised to be a darling. And really, I would think that in the market environment to come, there's a better than 50% chance that the EWZ, which is the MSCI Brazil Index, truly has an opportunity here. The leader of that nation has an opportunity to do some pretty stiff negotiation. I can't see him not doing it on behalf of his people. Again, this is the composition of the MSCI Brazil. The country really does have a lot of resources, some of which have been mined, some of which are not yet mined and put on the global markets. And I'm going to use this slide until I continue to get better slides. But this is global nickel production. And as you can see here, even though Brazil is the number 8 supplier, they're the number 3 as relates to reserves. And whenever you're hearing numbers quoted and you're thinking about what does the world look like next year, if your horizon is that far versus right away, you do want to kind of keep in your head, hey, are they saying that this is the largest producer, but there's another country that could bring those reserves on, and what does that imply? What would I look for? Just as you start to get this commodities picture straight in your head, just kind of realize that. I do think that with commodities, you do have a little bit of time to keep learning because commodities went through such a bear market that most people don't know a whole lot about them. And I've noticed that in the way that these stocks are trading. They're trading as if people are still coming up the curve. The futures, on the other hand, are not trading like that. They're trading like people know exactly what to do and how to take advantage. But the equities are surely doing so. And with that, I will go ahead and hit the pause button and take some questions. Anyone got any questions?
Yeah, May, Dave again. Pretend you're talking to a 5th grader. How does the dollar being U.S. currency, how's that bad for you, Russia debt? If I'm asking that correctly.
Oh, okay. So Russians are borrowing from U.S. investors and global investors, and they got to figure out what currency to pay you in, right? So like if you're a landlord, and let's say some folks just moved from Europe and they wanted to rent your house. Well, they got to pay your housing payments in US dollars. And if they don't have US dollars, then that's a problem. Now, they could be like, hey, I'll happily pay you in euro. And it just depends on the degree to which you're okay to accept euro. Most people are going to be like, no, friend, you need to find your own way to the bank and translate that into US dollars, and then you can give me the money in US dollars. Thank you very much. Some people might think differently and be like, fine, I'll take it in euro and I'll go to the bank myself. Or alternatively, maybe they're these debonair suave folks that go to Europe all the time and they're like, I love having euro, give me the euro, right? The one country that does not have sanctions of that nature on Russia would be China. And so if people were trying to work out a deal, Russia does have some access to renminbi, or to yuan. Sorry, I'm going to try to change it to what everybody else calls it, to yuan. So it is possible that this deal gets worked out by the investor saying, okay, I'll take yuan. But that would be the only other possibility that I could see in a workout, short of the sanctions being lifted from Russia and Russia getting access back to its bank accounts and its reserve assets. Did that make better sense? You guys got to let me know if I'm saying this too fast, because sometimes I skip
Well, yeah.
steps.
Okay, let's go back. Back on a global scale.
Okay.
China can buy Russian oil in euro dollars. Is that correct?
They can, but the price is typically set still in US. So Brent crude, that contract, the Brent contract,
Right.
and WTI, both the pricing is done in US dollars. So even if their payment is not done in US dollars, because those indices typically set the price, and if it's shifting around where it would settle at, you are still synthetically pegged to the US dollar.
Okay, yeah, but there, I mean, you have an exchange rate. I guess you have some risk if, I don't see the risk unless you're dealing in dollars. I mean.
Okay, it's kind of like this. Let me try it one more time. If you if the price of oil is set in dollars via the whatever it's trading in on Brent, if you're using the Brent price, or
Right.
WTI, right? Then as that
Mhm.
shifts up and down, that's the price of oil. Whether you decide that you're going to do the currency translation yourself in renminbi, or whether someone's willing, or in yuan, or someone's willing to accept yuan, they're going to
Mhm.
use the price in US dollars and then do the translation. That's what it means. That's what it means to have that as a. That's why it's so strategic. Does that make better
For
sense?
the dollar, yeah.
It's purely mechanistic. It's kind of
Okay.
like this. We are linked to for years, and it's still somewhat the case. The Hong Kong dollar is pegged to the US dollar at $7, whatever it is, right? So for Hong
Mhm.
Kong, they are 100%, even though China and the yuan is accepted in many parts of Hong Kong, you know what I mean? They are 100% pegged to the US dollar on the Hong Kong dollar. And as a result, the fluctuation of the US dollar relative to the yuan, oh, it's really hard for me to say it that way. The fluctuation of the US dollar to the yuan affects the Hong Kong citizen aggressively, even if they're being paid in yuan, because the
Gotcha.
fluctuation is relative to Hong Kong dollar because of that peg. This is really and I think this is really hard for so I'm glad you're asking. I think you actually probably know it a little better. You're being gentle and trying to make sure that I explain myself well. But these mechanistic aspects of global foreign trade, they are not really common except if you're a currency trader, or alternatively you're accustomed to trading across borders and across markets. So it isn't common knowledge for most people that are trading in the US markets or in a single market, like, wherever all the currency translation is done. So it's a little bit painful, I get it, to really appreciate the nature of what the peg is doing, and the sheer raw number of ways things are actually pegged to the US dollar.
Okay, I think what I was trying to get at was how that hurts the US
How hurts
being
the
the
US?
being the
It
reserve currency. You're
doesn't
saying
hurt
a
us at
lot of
all. It
that.
doesn't
Okay.
hurt us all.
I thought you
Our
said it
being
did.
a reserve, sorry?
I thought you said it did. Okay.
Oh, okay. So let me say it again so it's clear, because it might be. We are a reserve currency. It is
Right.
one of our major strategic advantages. And there was a little bit of a fall, and I think some of it, there was a bunch of things that happened in the 90s that allowed that fall to happen from the 70s through the 90s, really. I mean, but through the early part post World War II, most people reserved about, as a reserve currency, we're about 80% of the market, right? Because we were so stable and we came out of World War II like such amazing champs globally, financially, et cetera. Because relative wealth globally declined so dramatically. That's really in Ray Dalio's book. He does an amazing job explaining that. Um, in the last 20 years, we've seen reserve currency move from 80% to 60%, also described in Mr. Dalia's book. But we still are the majority of reserve currency. And that has to do with how much trade happens. That has to do with the various points in the marketplace for which things are priced in US dollars, whether you like it or not. So these are all really strategic things for the United States. To the extent that we are, through the way in which we are playing the economic piece of that dime game, here, let me just put this slide up to the extent that it's helpful to have a visual. To the extent that there are a number of things that are happening mechanistically in this game that is an instrument of national power, this one, and I add this here because it's the only real place that it could be within these four letters. But to the extent that is happening, we put at risk that strength, we put at risk this strategic thing that we have had for so long that has really helped our nation. And that's why I am not stoked at times on some of the things we're doing. And the major country that is really knowledgeable about this and has been very careful about how they've opened up pretty much every parts of their economy globally, which is why I was going through the China's timeline of how they open it up and how it relates to the ADR action that we're seeing right now is China. China has very much so really worked this E, because they're not going to work this M. That's not their deal. The I, they've worked a little bit more domestically than internationally, but somewhat internationally. And D, they've worked like crazy. That's why so many nations are like, look, you can be as crazy as you want with Russia. They only have 2 to 3%. But with China, we're going to have a little bit of a longer discussion, with that, because the game gets a little bit more, it's not a game that I want to see this world play. As far as things go. But the E and D, China's really good at it, really good at it. And right now, I think the net effect of the economic sanctions on Russia is for China to get very skittish about this aspect of E and start to kind of take measures to kind of go back more into this isolation, so to speak, or at least make sure that they're not creating a scenario where it's a little bit crazy for them to manage on the volatility on their side. I mean, think about this. What I was describing with the ADR and the ordinary market, even though and technically this VIE structure should protect Chinese companies from this kind of scenario, because of the mechanics between the ADR and the ordinary, push the ordinary market down as well. So these stocks were down, like in some cases 40%. The ordinary market was also down 40%. The only change that happened was people got up and sold it. You know what I mean?
Yeah, I was going to ask you about that. our position in DD, which is so far totally wrong. But how can the SEC let these companies come and raise $4.5 billion and then just leave? I mean, without having.
It's definitely been done before, which is why I wanted to get at white paper that existed.
At best, you lose your credibility.
Yeah, I mean, from time to time, like I said, there's a reason why some pension funds aren't even allowed to invest in not just one country, but like many, many, many countries. And some pension funds are only allowed to invest in a very handful of companies for a reason. Emerging markets requires that you have a deeper knowledge. I'm not going to say I have all the knowledge. In fact, like I said, I stick to the S&P 500, and when people try to talk to me about companies overseas, you'll always hear me very quickly tell you where my sidewalk ends in knowledge, for a reason. The legalities of those countries and the rules of the game are very different, and for someone that's trafficking that heavily, they know the rules of that game in a way that it wouldn't even occur to them to explain it to you. You know what I mean? But so that always bothers me whenever partaking of stocks that are international in nature. There's a lot to learn in every market. Specifically, though, with China, yes, from time to time, Chinese stocks do very strange things. In the 2010-2012 period, you had a bunch of SPACs come out that were Chinese listed companies. Those all went absolutely to zero, and they were all companies for which the folks that purchased them did zero due diligence. And there's nothing that the stock exchange can do about it because the investor wanted the product. And there's nothing the SEC can do about it except attempt to try to get more disclosure wherever possible. In this structure, investors wanted exposure to China, and they had limited ability to get it via the share class markets that China set up in Shanghai and through the Hong Kong market, because some accounts just can't do it that way. They need it to be an ADR. So yes, they listed, yes, people wanted exposure. Hopefully, folks that did that business on behalf of their investors, if they were doing it in an institutional fashion, understood this structure. To the extent that they didn't, that's obviously a problem. And also to the extent that they have some kind of fiduciary responsibility, I hope that they are trying to understand it better and are switching to the ordinary. The ordinary necessarily doesn't have this structure to it, and then you would have the ability to litigate as a shareholder relative to the rules of that nation. And like I said, whereas a lot of people are saying all this crazy stuff about China that I don't think is fair, in the sense that China will just take your assets or whatever, there's very little evidence of that in the last 10 years for public companies, right? More likely what they do is they just put the CEO in jail and let the company continue. That is very common. We don't even do that over here when we have, it takes a lot more effort for us to put a CEO in jail, but over there it doesn't take very much at all. You know what I'm saying? But
Right.
nonetheless, China doesn't have any real major feelings about this structure and its impact of foreign investors. They do, however, have a lot of feelings about concept orderly market. So I do think that to the extent that the shares that have already been discussed are going to delist, such as DD, et cetera, those shares will probably do so in an orderly fashion because I think what we discovered yesterday was a mechanistic issue between the ADR and the ordinary, which is just that the ADR market always tries to trade pari passu to the ordinary market. And in doing so, you can crush the ordinary market in the case that someone is forcing the translation a particular way and with a particular speed. The potential, like, I don't really know what happened yesterday. I'm not going to claim to know, but if I was to, I would want to investigate this further for sure, mechanistically.
Yeah, I mean, there's an arbitrage going on between
There's
ADRs.
gotta be. It's crazy, right?
I get it.
Yeah.
But I mean, I don't see why the SEC would ever allow an ADR to list on one of their, under
this
their
way?
yes.
You know what? I would say that this structure is not just used. China isn't the only country or company that has ever used this structure. I think what's really happened here is the size of the companies. So for smaller companies, which would have formed the precedent, it probably wouldn't be such a big deal in the stability of the financial markets. But these companies are real companies that make a lot of money and have massive growth at the same time. So I think that's why it might be coming to the forefront. The SEC is so far behind right now, though. The number of mechanistic errors and problems that are being exploited over the last 2 years is crazy. And the SEC appears, largely speaking, to not understand it. Not even like they're on it, they're investigating it after the fact. They just seem to actually not understand it conceptually. Sorry, I'm really I'm a huge fan of drone
don't
policy,
be
you guys
sorry.
know, but I'm really not a fan of the SEC. I feel like a lot of the things they do right now in modern times hurt the retail investor, not help the retail investor. And their failure to really appreciate the mechanisms of the marketplace is one of the biggest things they do that hurts the retail investor. So I'm really not a fan of the SEC. I've said it. Hopefully they don't come after me and get all angry with me, because if anything, I would love to help them out if ever I was given that opportunity. But I'm not. Everyone has their opinions, so for what it's worth.
Okay. Yeah, appreciate that. Thank you.
Are there any other questions? Sorry about that. All right. Well, let's see how this thing goes at 2:30. Good luck, everybody.
I just want to say, May, I want to commend you. You've been talking about stagflation for months.
Yeah, I've been worried about it like crazy.
Right. Okay. Well, they're just not starting to talk about it.
Yeah. Whew. Let's hope it doesn't go there. I still think that we've got some amazing people in office, and we've got some folks that are quite bright. So there's still, the fact is the U.S. consumer is very strong. These companies are actually in fantastic circumstances financially for the most part. The supply chain, that's a problem, and that's part of the reason why I'm really sensitive to wanting to see us resolve any kind of issues with China and not create yet another issue for the supply chain. But we shall see. We shall see. Hopefully cool heads prevail and wisdom prevails in the global arena. But all right, guys.
I wish he would raise a half a point.
Yeah.
What would that?
I know you do.
Yeah, I
don't know.
It shows strength in the economy. He's taking care of inflation. I mean, to me, that's very positive. If he does.
Okay, here I'll go back to it, and this is my real issue. I honestly don't know how the market's going to react. That's why, largely speaking, cash has been my favorite position into these kinds of market events, because now things that were just kind of a blip on market events are the FOMC minutes has never been just a blip. I don't want to be on air. I don't want to say that, but these things that would have had, let's call it a more muted effect, are now having not just an effect, but a significantly crazy effect as people try to digest them. If for no other reason than the buyers and sellers go down and shrink so aggressively that it just takes one or two players to move the market so much. But this is my issue with 50 basis points is that we still need that front part of the curve, the 1, 2, and 3 month to lift up. It would take you still below the 6 month. And in fairness, the 3 month I don't love, but 50 basis points only 15. It's only a this is actually not where the 3 month is. It keeps juggling around just 40 basis points. So 10 basis points, you can still get the lift on the 3 month. So it's flat versus inverted. 3 month and 6 month is a common place that people might borrow money to pay for inventory supplies that are coming in. And that's my real concern, is that you hurt folks that are trying to bring inventory in because you cut off their debt and make it impossible for them to do factoring, which is the debt that is oftentimes used for people that need really short amounts of cash flow for something that they've already either pre-sold or have a long history of selling in a very stable way. And so the 50 basis points wouldn't be ideal for me because it would really cut this 3 month off. In fairness, we are in the month of March, and so I think most of the buying would have happened in February, but we still do have some buying in March for the summer months to come. So it's not a nothing. You know, if rates really ever squeeze this front part of the curve as we enter into the buying season for holidays, which would happen in the June time period, it's different for different industries. So please, if you're in an industry and you're like, that is not when it happens, it's possible that I'm quoting a different industry or something like that. But typically for retail, you're going to start buying in that June time frame for having inventory on hand for November and also back to school. Some people will go a little earlier, some people go a little later. So, it just so happens that he might get a reprieve and the whole curve lifts. But yeah, so that's a thing. Any other questions?
No, great. Thank you.
All right, we'll see how it goes. Good luck to everyone. Bye.